Wall Street Week Daily segment. The host of Wall Street Week, David Westin, joins us every day around this time. And David, I'm sure, just like everyone else with the Bloomberg terminal, you were wrapped by that big spike that we saw in interest rates a little bit earlier today, back now to some of those cycle highs. I mean, we haven't seen rates like this in the Treasury market going back to 2006, 2007.
It changes the whole world, doesn't it? So much is based, for example, on the 10-year. And look at where the 10-year is now, just under, I think, 4.9. And it changes everything. One of the things we want to take a look at is to talk to somebody you know well, Shelia Patel. She's B Capital Group Vice Chair and General Partner. She deals with venture capital. So we said, how has that changed her world in venture capital?
The venture capital business growing up like every asset class grows up. It's been an unprecedented time of support for venture capital with the low rate environment we had, particularly post the global financial crisis. So you get to today, you say higher rates, tougher economies. I think it brings out the best in entrepreneurs and founders, but it's up to venture capitalists to find those people that can manage businesses through tough times. Prior cycles have shown that some of the best vintages come in tougher times, but higher rates are a bit of a new nuance for everyone to deal with.
Is it affecting venture capital's access to capital? Are people a little more reluctant to put money up?
Well, I would say there's been two big effects we've noticed over the last few years on money going into venture capital. One was at first the denominator effect, where venture had done so well that you saw many of the major allocators, whether they were pensions or sovereign wealth funds, just had too much. But they were getting distributions. The challenge you have today is exits are tough to come by. And so money is not getting recycled as easily. B Capital has been very fortunate to raise its latest fund, and you've seen some funds being able to put things together, but you definitely see a return to a more manageable size and a slower growth within the assets of venture capital.
In equities generally, it's thought as rates go up, values of equities go down because of the discount rate. Is there an equivalent in venture capital where people are saying, wait a second, as we pencil this thing out, if it's going to take longer to get it, and we have that kind of interest rate, that kind of yield, we're going to have to get more money at the end?
Well, the great discovery, I think, of the last 2 years is that math works the same in the venture world as it does in the rest of the world. Having sat on various roles in Wall Street for the last 30 years, it's no surprise to me, like every single asset class and investing style goes through that realization. It's absolutely the same for venture, and that's why you see more creativity in venture. That's why you see people realizing they have to think about their debt equity mix, they have to think about their business structure. Growth at all costs is not a solution. You can't grow your way out of this one. So it's a big learning, I think, but a very good one, because at the end it should help venture capitalists invest in more resilient companies.
How much runway do we have? Has that runway just gotten extended? I mean, it used to be when I had anything to do, it was like 18 months, 2 years, you need runway. Do you need more runway now?
Well, I would say certainly still 18 months to 2 years is a benchmark that people look to. I think some of the question becomes, what is your opportunity for extending the runway via fundraising? And only certain companies have that opportunity today. So it's both what is the runway now, but what is the future runway you might have? Many founders and entrepreneurs, of course, are reluctant to raise money at a flat round or even a decline to a prior round. And that means maybe they want a bit more runway if they think they can wait out the cycle or prove their business's worth and show certain developments and profits in their business to demand a higher multiple. But that means they need more time.
So the pot at the end of the rainbow has been the IPO, the initial public offering, right? Those have gone a little bit quiet. They're starting to come back now. Is hope coming back now about IPOs, given what you're seeing in the marketplace?
I definitely think hope is coming back about IPOs. There's a backlog of companies to present themselves to the markets. There's also a backlog of some interest from investors, but I don't think anybody expects a snapback of a miraculous style with a rebound in the number of IPOs kind of rescuing what's going on. I think it'll be a much slower burn. You still see in the public markets, and that translation of getting yourself from private to public, a demand for more than just a growth trajectory, a demand for a true profitable company with a profits trajectory and a trajectory alongside it of how they will grow revenues, how they will develop their products, et cetera. And unless you can make that story in a cogent way, I still think the IPO route is difficult and maybe further off as well for some of these companies.
Talk about your deal flow, what you see coming across your desk. I mean, AI has been all the rage now. Generative AI, everybody's going into that. Is that crowding out other opportunities?
I certainly think AI is kind of of the moment space in venture overall. But AI touches so many different sectors. So I think one of the interesting things about AI, certainly the area we focus, is not just tech for tech, right? And we can come to what that means for exits later. But just in AI in general, so much of the focus has been on what's being done by the big tech companies. What do they need? How can smaller companies innovate in like a GPT type space and so on? But we actually see an incredible opportunity for AI and invested in a number of companies that are helping traditional industries, right? Contract management is not very sexy, but contract management is pretty sexy if you can automate it and use AI to realize your due CPI increases from all of your clients that you didn't claim. And that's a boost to revenue with an existing client base that otherwise systematically your army of people were not discovering.
And that potentially is an exit that's not an IPO. That's a big traditional company saying we need to innovate by buying a tech company.
Exactly. So, a company like the example I mentioned, Icertis, has so many different applications. It has an opportunity to have a client base among the entire Fortune 500 and beyond. It certainly has application to tech companies, not the biggest of the big, but in many cases ones that are figuring out ways to offer enterprise services that mainline, mainstream, boring industries need every day.
Finally, Shelia, we all are very mindful of what's going on in the Middle East right now, the tragedy that we've seen, the horrific circumstances. And it fundamentally is a humanitarian issue. It's not a business issue. At the same time, we're all mindful of the fact that Israel has been so important to the tech sector, and particularly startups, and including in AI. Going out, and it's too early to know, but going out, do you think it may have longer term effects on Israel in the tech sector, and by the way, globally, because they're so integral?
Well, look, as you said, thinking about business or economies in the middle of a situation like this, it kind of pales in comparison to the loss of human life. And you have to condemn the violence towards innocent civilians and hope for a more peaceful resolution. I think that history has shown us entrepreneurs around the world, particularly in that region, though, have incredible resilience and there's incredible depth of talent. And hopefully, if the world can come together to a better solution and a peaceful resolution, I think you can see the industrious, engaged startup community there certainly help to contribute to that recovery.